The RBA held Australia's cash rate at 3.6% in November, as widely expected, voting unanimously to stay on hold. There was no discussion of either cutting or hiking rates, but make no mistake, this was not a dovish hold. Its updated forecasts show underlying inflation is now expected to remain above target until at least the end of 2027, even with 2 fewer rate cuts penciled in than 3 months earlier. It still sees unemployment barely rising and economic growth holding up too. It's a mix that suggests the easing cycle may already be over. The RBA acknowledged that last week's hotter than expected Q3 inflation print was materially higher than its prior forecast, though partly driven by what it deemed to be temporary factors. That gave the statement a brief dovish flavour, but the forecast stripped that away rapidly. If the RBA truly wanted to flag more cuts ahead, it could have easily marked inflation down towards the 2.5% midpoint or even lower with its new assumptions. Instead, it chose not to. It also noted that labour market conditions remain a little tight, the recovery in household consumption ongoing, and the housing market continues to strengthen. Hardly the language of a central bank that's worried about downside risks. The RBA also reminded us that it will take time to see the full effects of earlier rate reductions, a line that hints at the content to wait and watch for the time being. In markets, Australian 3-year government bond futures slumped to the lowest level since March, reflecting reduced expectations for further easing. Overnight index swaps now pricing less than 20 basis points of easing by the end of the third quarter next year, implying fewer than one full rate reduction is now expected. That's a big deviation from the profile pointing to multiple cuts before last week's inflation report. ASX 200 SPI futures have also broken down technically, slicing through a key uptrend and the important 50-day moving average as traders reassess the broader policy outlook. While the Australian dollar's immediate reaction was muted, the tone from the RBA lends itself to relative outperformance against the crosses if risk appetite continues to hold up.